And you say the Fed is not done yet. Does it hinge on whether what we saw last week was a pause and a skip? Is that language significant to you in terms of setting up expectations or uncertainty for the markets?
Pause, skip, maybe a hop, all sorts of interesting terms to throw about. It certainly matters how the Fed frames it. And if you think about the path for inflation, I think this whole battle always hinged for every central bank on where does inflation equilibrate and how quickly does it get there. And they just don't know, whether it's the policymakers at the Fed, the Bank of England, the RBA, I can go on, you name it. But it very much matters in terms of whether the guidance from Governor Waller is right or from Chairman Powell. Yes, we're probably not done. We've got a bit more to go. It matters quite a bit to financial markets.
Does that mean you're playing with opportunities, you think, that are still identifiable within these developed markets? Or are you turning to some of the other, maybe more compelling stories out there, like what the PBOC is doing?
Yeah, a bit of both. So within developed markets, a couple of things that stand out to us. We've been puzzled for a while now why the markets are pricing so much more easing by the Fed, especially next year, relative to other central banks. And here's one good comparison, Fed versus ECB. The amount of rate cutting the market's price next year out of the Fed is 120, 125 basis points, something like that. For the ECB, it's more like 55 or 60. That differential doesn't make a lot of sense to us. Bank of England's probably a different story, but at least in terms of the Fed versus the ECB, we think that gap narrows. What does it mean? It means a positive for the U.S. dollar versus the euro. We like that. We think also that when you look at the Japanese yen, it's been beaten down way too much. Its performance over the last month or so has been staggeringly bad. We think that probably slows down somewhat soon, maybe not quite yet, but a couple months out. And in rate space, too, you can look at opportunities to buy assets, let's say, in markets ex the U.S., because, again, we do think the market will price less easing by the Fed next year. So plenty of opportunity in developed markets, a fair bit in EM, too. I think there's a lot going on with respect to central bank policy paths being repriced.
I want to get to EMs, but I have to ask you about one of the toughest monetary policy decisions this week, which is coming from the Bank of England. What are you expecting given the wage growth there continues to accelerate?
The BOE is in a tremendously difficult position. We as a firm are calling for a 25 basis point hike. I think 50 wouldn't surprise anybody. And really the future path is unknown. So our economics team, frankly, looking at let's say the run rate of inflation, core inflation that is, for the UK early next year, they think it's probably 3.5 to 4, which is high, but it could be 4 to 4.5, and the risk is to the upside in their view. So really difficult challenge for the BOE. The inflation problem is by no means under control. And in addition to all the factors other central banks have to face, they still have the Brexit hangovers. So 25 this week, but probably quite a bit more on the way, bottom line.
When you have hawkish central banks in developed economies, what does that mean for emerging markets?
Typically, it's negative, and you can imagine why. You've got rates going up, and people say, oh, well, all right, that probably means that let's say the U.S. dollar, the G10 currencies are doing well. We're going to send more capital that way. But the interesting thing about this cycle is emerging market central banks were ahead in terms of hiking policy, not so much last year, but the year prior. So if you go back to 21, there was a lot of hiking across the EM complex, not that much in developed markets, whereas in 22, developed market central banks caught up. So it's been a bit of a seesaw battle. So I'd say it's not really a straightforward comparison. We can't necessarily trot out the last 4 to 5 major tightening cycles by developed market central banks and say, aha, we know what to do now, because this one has been so different in terms of timing.